unless the conditions precedent for a decline in gold come to exist, which is to say, a balanced budget, positive real interest rates, and the end of quantitative easing, I'm not afraid of another 15 years of stagnant gold prices.
You're watching Silver News Daily. Subscribe for more. Rick Rule, a legendary natural resource investor, has just made a jaw-dropping prediction about the silver market that could change everything you know about investing. Imagine silver reaching an unprecedented $3,000 per ounce. Yes, you heard that right. Stay tuned to find out how this incredible rally could unfold and what it means for you. If you're interested in the future of silver and how you can benefit from this potential boom, you won't want to miss this. And don't forget to subscribe to our channel for more insights and updates.
I suspect because people don't trust each other, you need a medium of exchange that's globally accepted. The dollar is that. I have, from a prior life, a lot of experience with sovereign wealth funds. And I remember conversations with a couple of Asian sovereign wealth funds asking them whether they actually trusted the US government. And they said, of course not, but we trust them more than we trust each other. Some would argue that Bitcoin, as an example, could function as a global medium of exchange. My suspicion is that the float, pick a price, is too small. And that global adoption, is too far away. Others suggest that the BRICS could become the global reserve currency. The trouble is that none of the underlying currencies that would form the BRICS are convertible. So that's a bit of a problem. And as little as those countries trust us, they trust each other less. Can you imagine what the Chinese would feel like if they developed a treasury chest of a couple billion or trillion euros, or not euros, I'm sorry, rubles, and they went to Russia to cash in? That doesn't work. I'm 71 years of age, and I suspect that for the balance of my lifetime, and I intend to live a long time, that the dollar will still be the world's reserve currency, albeit not as dominant as it has been and not as dominant as it is today.
We've got a number of questions here that are fairly specific, so maybe those will just take a moment each, but maybe they'll take longer. This one is one we've talked about before from Christian Siegel. Rick, being essential for Trilogy Metals, do you think the Ambler access road will eventually be permitted after having not been permitted recently?
I absolutely do think that the Ambler road will be permitted, but I think it'll take 5 years or so. Trilogy needs to do a better job with the native corporations in Alaska. Rural politics in Alaska is controlled by indigenous people. And Trilogy has spent way too much time in Washington, who hate them, and not enough time with the indigenous people of Alaska, who have the political will, and some would say the political franchise, to move the debate along.
Let's dive into the current state of the silver market and explore the factors driving its recent performance. Silver has been on an impressive rise, recently approaching a 2-week high of $28.80 per ounce. This surge in silver prices can be largely attributed to the weakening of the US dollar, which has lost some of its strength despite the United States Bureau of Labor Statistics publishing a Producer Price Index, PPI, report indicating persistent price pressures. In April, the PPI grew at a faster rate of 0.5% compared to the estimated 0.3%. This suggests that inflation remains a significant concern, which typically boosts the appeal of precious metals like silver as investors seek safe havens to protect their wealth. The core PPI, which excludes volatile food and energy prices, also increased by 0.5%, aligning with annual headline and core PPI data growth rates of 2.2% and 2.4%, respectively. These inflationary trends have led to speculation that the Federal Reserve might delay any rate cuts beyond September, or even maintain the current interest rates of 5.25%, 5.50% for the rest of the year. The US Dollar Index, DXY, which measures the dollar's value against a basket of 6 major currencies, has fallen to 105.00. This decline in the dollar enhances the attractiveness of dollar-denominated assets like silver, as it becomes cheaper for foreign investors to buy silver when the dollar weakens. Additionally, the 10-year U.S. Treasury yields have decreased to 4.46%, reducing the opportunity cost of holding non-yielding assets such as silver. This week, all eyes are on the upcoming U.S. Consumer Price Index, CPI, data for April, which will be a crucial indicator for predicting future movements in silver prices, the U.S. dollar, and bond yields. Investors are also closely monitoring the monthly retail sales figures that will be released alongside the CPI data. These economic indicators are vital as they provide insights into consumer spending and inflation trends, further influencing investor sentiment and market dynamics. Silver's recent performance has been bolstered by technical factors as well. After finding strong buying interest near the horizontal support level around $26.09, which was a major resistance point in mid-April, silver prices have rebounded sharply. This recovery indicates renewed bullish sentiment among investors. The near-term outlook for silver has improved significantly as it has returned above the 20-period exponential moving average, EMA, currently trading around $27.30. Furthermore, the 14-period Relative Strength Index, RSI, has shifted into the bullish range of 60.00-80.00, suggesting
gold prices
that a bullish
are
momentum
as low
has been
as they
triggered.
are.
These recent
Perhaps
developments in the
because
silver
I lived
market
through the
are
decade of
creating
the
a perfect
70s,
storm that could potentially
and I
drive
know what
prices even
inflation
higher.
looks like, and I know what
With
stagflation looks
inflationary
like,
pressures remaining
and
persistent,
I know that the
the
only
Federal
way
Reserve's
out of the
cautious
fiscal
approach to rate
situation
cuts
that confronts
and
the
the
United
weakening
States
U.S.
and many
dollar,
other
silver
countries
is positioned to
is
continue
the
its upward
debasement of the
trajectory.
currency.
As we move forward,
I'm
the
surprised
CPI and
that it
retail
has
sales
taken
data
as
will play
long
a
as it
critical
has
role in shaping market
for
expectations
investors to
and
come to
determining the next phase
understand
of silver's
that they
price
need to
movement.
own some gold and
Stay
silver.
with us as
Now,
we
the
delve
truth
deeper
is that
into
if
the
I paid
historical
more
value
attention
of
to my own
silver,
personal
its
history,
relationship with
this would be
gold, and
understandable.
why experts like
As a
Rick
high
Rule
school
believe in its
student in
incredible potential.
1967,
If you're finding this
I
information
began to
valuable,
be
make sure to
aware
subscribe to our channel and hit the
that
notification
the
bell to stay
debt
updated with
in
the
the United
latest
States
market
and the
insights and
deficits
expert
associated
predictions.
with guns and butter were unsustainable. Did I do anything about it? No, I was a high school student and I was broke. But more importantly, did investors? No. The truth was, it took until 1972 or 1973 before the ravages of inflation had caught up with individual investors. Remember that by 1970, the world had been through 25 years of pretty benign economic climb after the end of World War II. And people were accustomed to think that things got better and better and better. And they didn't pay attention to nagging little problems like debt and deficits until over 5 years, the gasoline price went from 20 cents a gallon to $1 a gallon. Until the price of a hamburger at McDonald's went from $5 to $1, which is to say 20 cents each, to 75 cents each. After 5 years, the perniciousness of inflation became apparent to people, and they began to pay attention to it. So the fact that it's taken people some time after a 40-year period of benign economic climate makes absolute sense to me when I think of it in that context. It's my belief that we have, for the purposes of this discussion, two time frames to talk about, 1982 to 2022, with U.S. dollar hegemony very strong and the interest rate, both nominal and real, falling. And then we have a sea change at the end of 2022 with the interest rate rising. That interest rate rising heralds the beginnings of a new era, one that will survive, but one that will be challenging. The circumstance that we have in front of us, the debt and deficit in the United States, we've seen before. You will not cut spending. That's not what the voters will tolerate. And you won't raise taxes too much. So how do you get out of there? Well, you debase the purchasing power of the currency. In other words, you devalue the debt that you have by printing. In the decade of the 1970s, we devalued the U.S. dollar in terms of the basket of goods and services that Americans live on by over 80%. And of course, that coincided with a meteoric rise in the gold price. The way we get out of stagflation this time is very likely the debasement of the currency that the debt is denominated in. So I think past this prologue. That's a long-winded answer by way of saying no, unless the conditions precedent for a decline in gold come to exist, which is to say, a balanced budget, positive real interest rates, and the end of quantitative easing, I'm not afraid of another 15 years of stagnant gold prices.
This is a fascinating question. I hope you'll dig into it for us, because it really picks the brain of some people who, I think, a class of people who would be influential.
Let's delve into the crucial factors of inflation and the Federal Reserve's policies, which are significantly impacting the silver market. The recent Producer Price Index, PPI, report from the United States Bureau of Labor Statistics indicates persistent inflationary pressures, with monthly headline PPI growing at a faster rate of 0.5%, surpassing the estimated 0.3%. The core PPI, which excludes volatile food and energy prices, also rose by 0.5%, aligning with annual headline and core PPI data growth rates of 2.2% and 2.4%, respectively. This stubborn inflation suggests that price pressures are not easing as quickly as expected, complicating the Federal Reserve's decision-making process regarding interest rates. Inflation is a critical factor for the silver market. Historically, precious metals like silver have been viewed as safe haven assets during times of rising inflation. This is because they tend to retain value better than fiat currencies, which can lose purchasing power in an inflationary environment. As inflation remains persistent, investors are increasingly looking towards silver to hedge against the devaluation of their currency holdings. The Federal Reserve's response to inflation is another crucial element influencing the silver market. With the PPI data indicating ongoing inflationary pressures, there is growing speculation that the Federal Reserve may delay any interest rate cuts beyond September or even maintain the current interest rates of 5.25%, 5.50% for the remainder of the year. Higher interest rates typically strengthen the US dollar, which can be detrimental to silver prices since silver is priced in dollars. However, if the Federal Reserve decides to delay rate cuts, this could keep the US dollar relatively weaker, supporting higher silver prices. Furthermore, the Federal Reserve's monetary policy stance has broader implications for the economy and financial markets. If the Fed maintains high interest rates to combat inflation, it could slow down economic growth, potentially leading to a recession. In such a scenario, investors might flock to safe haven assets like silver, driving up its price. Conversely, if the Fed opts to cut rates to stimulate the economy, it could lead to a weaker dollar and higher inflation, both of which are positive for silver prices. Adding to this complexity is the current performance of the US dollar index, DXY, which measures the dollar's value against a basket of 6 major currencies. Recently, the DXY has fallen to 105.00, despite the Federal Reserve's tight monetary policy. This decline in the dollar enhances the appeal of dollar-denominated assets like silver, as it becomes cheaper for foreign investors to purchase silver when the dollar weakens. Moreover, the 10-year U.S. Treasury yields have fallen to 4.46%, further influencing the silver market. Generally, higher yields on interest-bearing assets like bonds make non-yielding assets, such as silver, less attractive. However, the current scenario is different. Despite inflation fears, bond yields have dropped, diminishing the opportunity cost of holding silver and making it a more attractive investment. As we anticipate the upcoming U.S. Consumer Price Index, CPI, data for April, it becomes even more critical. The CPI will provide a clearer picture of consumer inflation and could significantly influence the Federal Reserve's future actions. Alongside the CPI, the monthly retail sales data will also be closely watched, as it offers insights into consumer spending trends. These economic indicators will help investors gauge the future direction of inflation and interest rates, thereby impacting silver prices. In summary, the interplay between persistent inflation, the Federal Reserve's interest rate policies, the US dollar's performance, and bond yields are all critical factors driving the silver market. As these dynamics evolve, they create a complex but potentially highly favorable environment for silver, setting the stage for a possible rally to unprecedented levels. Stay with us as we continue to explore the historical value of silver, its unique characteristics compared to gold, and the insights of industry experts like Rick Rule, who foresee a remarkable future for this precious metal. Don't forget to subscribe to our channel for more in-depth analyses and market updates.
In three things. The first is compounding, which requires patience. A lot of investors who don't have a philosophical precept have trouble holding stock over a long weekend. The second thing that I think investors need to remember is that markets work over time. And if you're patient, time works for you. The cure for low prices is always low prices, and the cure for high prices are always high prices. It's difficult for people to understand that. High prices validate the theory that caused them to buy it, and they're loath to sell when prices are high, but they need to be, they need to be around that. The third thing is reversion to mean. We've talked before about, as an example, gold's median market share relative to other savings and investment classes. I don't know where the gold price is going to go. What I know is that in terms of its market share, about 0.5% of the market capitalization of all asset classes of savings and investment assets in the United States is denominated in precious metals. The 4-decade mean is 2%. Will it go to 3% or 4%? In other words, will it overshoot to the upside before settling out to mean? Likely. Will it actually revert to mean? Not exactly. But I'm a huge believer in reversion to mean. Once you start accommodating yourself to three things: patience, which is compounding, the fact that markets work, and reversion to mean, you are less inclined to going and chasing these idiotic fads. In particular, fad chasing is dangerous if you don't know anything about the underlying industries that you're trying to implement those strategies about. So people tell me all kinds of cool things about technology, and I listen to them out of interest because I'm an interested guy, but I don't invest in technology because I don't understand it. People tell me about all kinds of consumer trends. That's great. I love it. I'm glad that there's lots of things that people can buy that make them happier. But I'm disinclined myself to invest in them because I don't understand them. I stick to what I know. And by sticking to what I know, using time, which is to say compounding, the sense that markets work, and the concept of reversion to mean, over the fairly long term, I seem to do okay, irrespective of the fact that I'm not an ambulance chaser or a trend chaser.
Now let's take a deeper look into the historical value of silver and its role in the financial markets. Silver's history as a unit of value stretches back to ancient Greece and spans centuries, far surpassing the duration that gold has held such a status. For a long time, major economies around the world used the silver standard, valuing silver not just as a precious metal, but as a fundamental currency that underpinned economic transactions. In the modern era, we have transitioned to fiat currencies that are no longer tied to precious metals. Despite this shift, silver still holds significant value, especially in times of economic uncertainty. Historically, silver has been viewed as a hedge against inflation, similar to gold. This perception is rooted in silver's ability to retain its value when the purchasing power of fiat currencies declines due to inflationary pressures. Silver's current price, around $28.55 per ounce as of mid-May 2024, represents a significant increase from its lower levels in previous years. For instance, silver prices bottomed at $20.69 per ounce in October 2023 before experiencing a rally. This upward trend mirrors a broader historical pattern, where silver prices have risen during periods of economic turbulence and inflationary fears. Interestingly, silver's price movements often correlate with those of gold, although silver tends to be more volatile. While gold is predominantly driven by its role as a safe haven asset and a hedge against inflation, silver's demand is heavily influenced by its industrial applications. Silver is widely used in electronics, solar panels, electric vehicles, and chemical catalysts, which ties its price to the broader economic cycle and industrial demand. This dual demand, as both a precious metal and an industrial commodity, makes silver unique. During times of economic growth, industrial demand for silver can drive prices higher. Conversely, during economic downturns, while industrial demand may wane, silver often gains from its safe haven appeal, albeit with more pronounced price swings compared to gold. The historical volatility of silver can also be attributed to its smaller market size compared to gold. This means that even modest investment flows into or out of the silver market can cause significant price fluctuations. Additionally, silver is often a byproduct of mining other metals such as gold, copper, and zinc, which further complicates its supply dynamics. Looking back at historical data, we see that silver has had periods where it outperformed gold as an inflation hedge. For instance, During the late 1970s and early 1980s, silver prices soared alongside gold as inflation rates hit double digits. However, silver's performance has not always been consistent. There have been times when silver did not keep pace with inflation, reflecting its complex market dynamics. Despite its volatility, silver remains an attractive investment for those looking to hedge against inflation and economic uncertainty. Its industrial uses ensure a base level of demand, while its historical role as a store of value offers protection against currency devaluation. Rick Rule's extensive experience in natural resource investments highlights the potential of silver. He recognizes that while silver's market behavior can be erratic, its intrinsic value and dual demand profile provide significant opportunities. Rule's confidence in silver's future potential stems from his understanding of these historical patterns and market dynamics. As we move forward, it is essential to consider both the historical context and current market conditions. The persistent inflation, Federal Reserve's monetary policies, and weakening U.S. dollar are creating a favorable environment for silver. Historical data suggests that in such scenarios, silver can experience substantial price rallies. Stay tuned as we continue to explore the intricate relationship between silver and gold, the market factors driving silver's volatility, and why experts like Rick Rule are bullish on its future. If you're finding these insights valuable, make sure to subscribe to our channel for more detailed analyses and expert predictions on the silver market and beyond.
With publicly listing businesses like A-Mark, I'm not an A-Mark shareholder because they have on occasion employed too much debt on their balance sheet. And I wondered when I looked at their income statement and balance sheet if I was smart enough to run a business like that. I decided that I wasn't. Hopefully, they are. Being public gives a company like A-Mark certain advantages. If they need to go to raise equity, you don't have too much of a discussion over price. The market sets the price, plus or minus 10 or 15%. So I don't have any difficulty with that. And if you believe that there is going to be greatly increased demand for small denomination precious metals in collectors' hands, A-Mark may be the only legitimate way, other than buying physical gold and silver itself, that an investor can participate in the game.
Now let's take a deeper look into the historical value of silver and its role in the financial markets. Silver's history as a unit of value stretches back to ancient Greece and spans centuries, far surpassing the duration that gold has held such a status. For a long time, major economies around the world used the silver standard, valuing silver not just as a precious metal, but as a fundamental currency that underpinned economic transactions. In the modern era, we have transitioned to fiat currencies that are no longer tied to precious metals. Despite this shift, silver still holds significant value, especially in times of economic uncertainty. Historically, silver has been viewed as a hedge against inflation, similar to gold. This perception is rooted in silver's ability to retain its value when the purchasing power of fiat currencies declines due to inflationary pressures. Silver's current price, around $28.55 per ounce as of mid-May 2024, represents a significant increase from its lower levels in previous years. For instance, silver prices bottomed at $20.69 per ounce in October 2023 before experiencing a rally. This upward trend mirrors a broader historical pattern, where silver prices have risen during periods of economic turbulence and inflationary fears. Interestingly, silver's price movements often correlate with those of gold, although silver tends to be more volatile. While gold is predominantly driven by its role as a safe haven asset and a hedge against inflation, silver's demand is heavily influenced by its industrial applications. Silver is widely used in electronics, solar panels, electric vehicles, and chemical catalysts, which ties its price to the broader economic cycle and industrial demand. This dual demand, as both a precious metal and an industrial commodity, makes silver unique. During times of economic growth, industrial demand for silver can drive prices higher. Conversely, during economic downturns, while industrial demand may wane, silver often gains from its safe haven appeal, albeit with more pronounced price swings compared to gold. The historical volatility of silver can also be attributed to its smaller market size compared to gold. This means that even modest investment flows into or out of the silver market can cause significant price fluctuations. Additionally, silver is often a byproduct of mining other metals such as gold, copper, and zinc, which further complicates its supply dynamics. Looking back at historical data, we see that silver has had periods where it outperformed gold as an inflation hedge. For instance, during the late 1970s and early 1980s, silver prices soared alongside gold as inflation rates hit double digits. However, silver's performance has not always been consistent. There have been times when silver did not keep pace with inflation, reflecting its complex market dynamics. Despite its volatility, silver remains an attractive investment for those looking to hedge against inflation and economic uncertainty. Its industrial uses ensure a base level of demand, while its historical role as a store of value offers protection against currency devaluation. Rick Rule's extensive experience in natural resource investments highlights the potential of silver. He recognizes that while silver's market behavior can be erratic, its intrinsic value and dual demand profile provide significant opportunities. Rule's confidence in silver's future potential stems from his understanding of these historical patterns and market dynamics. As we move forward, it is essential to consider both the historical context and current market conditions. The persistent inflation, Federal Reserve's monetary policies, and weakening U.S. dollar are creating a favorable environment for silver. Historical data suggests that in such scenarios, silver can experience substantial price rallies. Stay tuned as we continue to explore the intricate relationship between silver and gold, the market factors driving silver's volatility, and why experts like Rick Rule are bullish on its future. If you're finding these insights valuable, make sure to subscribe to our channel for more detailed analyses and expert predictions on the silver market and beyond.
Dollar is the worst currency in the world, with the sole exception of all the others. We have the deepest and most liquid securities market in the world, the U.S. Treasury market. And for all its faith, the dollar relative to any other fiat currency is pretty good. That means, despite the fact that I know as a saver at current interest rates that I am losing purchasing power on an annual basis, I maintain a fair bit of U.S. dollar liquidity. I consider what is in effect a negative interest rate, which is to say, the destruction of some of my purchasing power, as an option payment, because I've learned in my life that having liquidity during momentary panics, during times when there isn't liquidity, gives me the tools and hopefully the courage to take advantage of illiquid situations rather than being taken advantage of or by them. I do not make long-term investments in the U.S. dollar. I'm not a holder of treasuries with a date longer than 2 years. I invest in things where time is on my side, and the dollar is not one of those. But I certainly am a holder of U.S. dollar liquidity because I suspect that the things I'd like to buy in a panic will be denominated in dollars. I am also a holder of liquidity in gold. But if you are going to be a holder of liquidity in gold, you have to be psychologically willing to sell it. I remember very well in a couple prior panics, clients of mine who had large gold holdings were unwilling to sell it, to use the stored wealth in gold to diversify into asset classes that stood a better chance of performing in the panic. So for those people, their gold wasn't liquidity, particularly in 2008, when, as a consequence of illiquidity, the gold quote fell too. So it's important that if you hold gold for liquidity, which I do, that you maintain the psychological predisposition to be able to sell it, to use some of it to acquire other asset classes that you think will perform better for you.
Now let's explore the fascinating dynamics between silver and gold, two of the most coveted precious metals. While their prices often move in tandem, reflecting their roles as stores of value and hedges against inflation, their demand drivers and market behaviors exhibit significant differences that investors should understand. Gold is primarily driven by its status as a safe haven asset. Investors flock to gold during times of economic uncertainty, geopolitical tensions, and inflationary pressures. Gold's demand is also bolstered by its use in jewelry and as a reserve asset for central banks. These factors contribute to gold's relatively stable and predictable price movements compared to silver. Silver, on the other hand, has a dual role. It is both a precious metal and an industrial commodity. While silver, like gold, is seen as a hedge against inflation and economic instability, A substantial portion of its demand comes from industrial applications. Silver is used extensively in electronics, solar panels, electric vehicles, medical equipment, and various other technologies. This industrial demand ties silver's price closely to the broader economic cycle, making it more volatile than gold. This volatility is evident when we compare the historical price movements of silver and gold. For instance, during economic expansions, industrial demand for silver can drive prices higher, leading to periods where silver outperforms gold. Conversely, during economic downturns, industrial demand may decline, causing silver prices to drop more sharply than gold. However, during these downturns, silver can still benefit from its safe haven appeal, albeit to a lesser extent than gold. One key difference between silver and gold is market size. The silver market is significantly smaller than the gold market, meaning that price movements in silver can be more pronounced due to relatively smaller changes in supply and demand. A modest investment in the silver market can have a more substantial impact on prices compared to the same investment in gold. This smaller market size contributes to silver's higher volatility. Furthermore, silver is often produced as a byproduct of mining other metals such as gold, copper, and zinc. This means that silver supply can be influenced by the production levels of these primary metals, adding another layer of complexity to its price dynamics. When the prices of gold, copper, or zinc rise, mining activities for these metals increase, inadvertently boosting silver supply. Conversely, when the prices of these metals fall, silver supply can tighten, potentially driving up prices. The relationship between silver and gold can also be seen in their price ratio, commonly referred to as the gold-to-silver ratio. Historically, this ratio fluctuates, reflecting periods where one metal outperforms the other. For example, during times of strong industrial demand, silver may outperform gold, causing the ratio to narrow. Conversely, during periods of economic instability, gold's safe haven appeal may lead it to outperform silver, causing the ratio to widen. Investors often use the gold-to-silver ratio as a tool to gauge the relative value of the two metals. A high ratio may indicate that silver is undervalued compared to gold, presenting a potential buying opportunity. Conversely, a low ratio may suggest that silver is overvalued relative to gold. Rick Rule, with his extensive background in natural resource investments, understands these dynamics well. He acknowledges silver's volatility, but also sees its potential for significant gains, particularly in the current economic environment marked by persistent inflation and uncertainty. Rule's bullish outlook on silver is grounded in its unique demand profile and historical performance as both a precious metal and an industrial commodity. Understanding the interplay between silver and gold is crucial for investors looking to diversify their portfolios and hedge against various economic scenarios. While both metals offer protection against inflation and currency devaluation, their differing market drivers and behaviors provide unique opportunities and risks. As we delve deeper into the factors contributing to silver's volatility and explore expert insights, remember to stay connected with our channel for more in-depth analyses and market updates.
Selling of the dominant
already,
class of
subscribe
assets.
and hit the notification bell to
I
ensure
think
you don't miss any
ironically,
valuable content on the precious metals market and other investment
and I know this is
opportunities.
counterintuitive, a declining interest rate would bring us to the point where we were nervous about the return of inflation, which normally prompts institutional investors to go to gold and silver. In this particular case, the sense of persistently higher interest rates means that the capitalized value of their long bond portfolio falls at the same time that their cost of funding it or their needs increase. It's disintermediation out of long-term debt that drives the gold price. It's important, I think, for your listeners to recognize that the increase in the gold price that we have seen in the last 2.5 years, from circa $1,800 to $2,200-$2,300, a 20% move that we're seeing today, hasn't occurred because of institutions, and it hasn't occurred because of individuals. The move that we've seen in gold so far is all about central bank buying. So the only motivated buyer has been the buyer that's afraid of U.S. dollar hegemony. We haven't seen buying that is afraid of the deterioration of the purchasing power of the U.S. dollar. If you look at almost any currency in the world except the U.S. dollar, you will see that gold has broken out into real all-time highs. In US dollar terms, there are some people who suggest that this is a real high, but they forget about constant dollar measurements. For a constant dollar measurement to break out into a high in US dollar terms, I think it's $2,700 or $2,750 gold, which I'm
Now let's delve into the factors contributing to silver's market volatility and why it behaves differently compared to gold. Silver's unique position as both a precious metal and an industrial commodity results in distinctive market dynamics that investors need to understand. Industrial demand. A significant portion of silver's demand comes from its industrial applications, including electronics, solar panels, automotive components, and medical devices. About half of the annual demand for silver is driven by these industrial uses. This makes silver highly sensitive to economic cycles. During periods of economic growth, industrial demand for silver increases, driving up prices. Conversely, during economic downturns, industrial demand diminishes, leading to a drop in prices. For example, the expanding adoption of renewable energy technologies, particularly solar panels, has driven up the demand for silver due to its superior electrical conductivity and reflective properties. Similarly, the burgeoning electronics and electric vehicle markets contribute to the growing industrial demand for silver. Market size. Silver's market size is considerably smaller than gold's. This smaller market size means that price movements in silver can be more volatile due to relatively smaller changes in supply and demand. Even modest investment flows into or out of the silver market can result in substantial price fluctuations. This characteristic makes silver more susceptible to speculative trading and sharp price swings compared to gold. Supply dynamics. Silver is often a byproduct of mining other metals such as gold, copper, and zinc. This byproduct nature means that silver's supply is influenced by the production levels of these primary metals. When the prices of gold, copper, or zinc rise, mining activities for these metals increase, which can lead to higher silver output. Conversely, when the prices of these metals fall, silver production may decrease, potentially tightening supply and driving up prices. Unlike gold, which is mined specifically for its values, silver's supply can be more erratic due to its dependency on the production of other metals. This dynamic adds a layer of complexity to silver's market behavior. Historical volatility. Silver has historically exhibited greater price volatility than gold. This volatility can be attributed to its smaller market size and significant industrial demand. During times of economic uncertainty, silver prices can experience sharp declines, followed by strong rebounds as investor interest in precious metals surges. For instance, during the 2008 financial crisis, silver prices plummeted but later rebounded sharply. Similarly, during the COVID-19 pandemic, silver experienced significant price swings due to disruptions in industrial demand and increased investor interest in safe haven assets. Investor sentiment and speculation. Silver's dual role as a precious metal and industrial commodity makes it attractive to a wide range of investors, from those seeking a safe haven to those betting on industrial growth. This broad appeal can lead to significant price swings based on changing investor sentiment and speculative activities. During periods of high inflation or economic instability, investors may flock to silver as a hedge, driving up prices. Conversely, during times of expected industrial growth, speculative investors might push prices higher in anticipation of future demand. Rick Rule's insights. Rick Rule, with his extensive background in natural resource investments, understands silver's market volatility, but also its potential for substantial returns. He recognizes that while silver can be unpredictable, its unique characteristics offer significant opportunities, especially in the current economic climate marked by persistent inflation and a weakening US dollar. Rule's bullish outlook on silver is grounded in its historical performance and the expectation that industrial demand will continue to grow. He believes that the combination of persistent inflation, Federal Reserve policies, and ongoing industrial demand creates a favorable environment for silver. In summary, silver's volatility is driven by its industrial demand, smaller market size, supply dynamics, and investor sentiment. While these factors contribute to its unpredictability, they also create opportunities for significant gains. Understanding these dynamics is crucial for investors looking to navigate the silver market effectively. Stay with us as we continue to explore expert insights and the future potential of silver. If you find these analyses valuable, make sure to subscribe to our channel and hit the notification bell to stay updated with our latest content on precious metals and investment opportunities.
Can you imagine the woke Democrats acting against the consolidated interests of the tribal corporations in Alaska? Can you imagine the impact that a tribal delegation in regalia and tom-toms might have in Washington, and the ability of the woke elites to stand up against them? Can you imagine the impact in the Alaska state legislature, although that Alaska state legislature is in favor of the road, to stand up to the political forces that run rural Alaska? Trilogy needs to go back to the drawing board, and they need to get the indigenous people, particularly the tribal corporations in Alaska, more solidly on their side.
Christian Siegel also asked, what are your thoughts about newfound gold and the impressive grades they drill?
Very impressive grades and a wonderful exploration job. I'm having a difficult time tying what's clearly a lenticular deposit into one overall deposit. It looks to me like a string of pods. And I'm having a difficult time understanding the economics of that string of pods. As a consequence of that, I don't own it. I will note that a good friend of mine and former business partner of mine, Eric Sprott, who is a legitimate billionaire, feels differently. So you need to listen to both sides of the discussion.
Another one, Carlos Martinez says, what are the things that concern you the most about the drilling program of Hercules Silver this summer?
Well, the thing that I guess worries me the most about Hercules is that they're doing sole risk exploration for a porphyry. Their discovery hole was truly a gaudy hole. But porphyry exploration is not for the faint of heart, nor is it for the poor. One thing that could go wrong is it might not be there. It could be a solid whiff. The second thing that could go wrong is that it might take them 100 holes or 120 holes to find it, and they'll have to continue to dilute. The third circumstance is that their geological thesis might be right, and they might tack it. I have to say, when I looked at the core, when I looked at the bornite in that discovery hole, I got awfully excited.
Let's delve into Rick Rule's unique perspective on the silver market, drawing from his extensive experience and deep understanding of natural resource investments. Rick Rule, a renowned investor in the precious metals sector, has consistently emphasized the intrinsic value and potential of silver, particularly in the context of current economic conditions. Rick Rule's background and expertise. Rick Rule began his career in the securities business in 1974 and has been principally involved in natural resource security investments ever since. With over 4 to 5 years of experience, he has financed numerous exploration and mining companies, making him a highly respected figure in the industry. Rule's focus on sub-billion-dollar market capitalization public and private issuers in natural resources provides him with a unique insight into the opportunities and challenges within the sector. Rule's view on silver as a safe haven. Rick Rule views silver as a notoriously volatile metal, capable of wide price swings in either direction. Despite this volatility, he sees silver as a valuable safe haven investment, particularly in times of economic uncertainty and inflation. While many investors turn to gold as a traditional hedge against inflation, Rule believes silver offers a compelling alternative due to its dual role as both a precious metal and an industrial commodity. Industrial demand and growth potential. One of the key factors driving Rick Rule's bullish outlook on silver is its industrial demand. Unlike gold, which is primarily used for investment in jewelry, silver has extensive industrial applications. From electronics and solar panels to electric vehicles and medical devices, silver is an essential component in many high-growth industries. Rule recognizes that this industrial demand creates a solid foundation for silver's value, providing a buffer against market volatility. Silver mining companies. Rule also highlights the importance of investing in silver mining companies with strong balance sheets and experienced management teams. These companies are well positioned to capitalize on high silver prices and weather periods of low prices. Some of the most profitable silver mining companies even offer dividends, providing investors with a degree of security and income. Rule's focus on these companies underscores his belief in the long-term potential of the silver market. Historical context and future outlook. Drawing from historical data, Rule points out that silver has often followed gold in terms of price movements, but with greater volatility. He acknowledges that while silver's track record as a hedge against inflation is not as strong as gold's, its industrial demand offers unique growth opportunities. Rule's confidence in silver is further bolstered by current economic indicators, including persistent inflation and the Federal Reserve's cautious approach to interest rate cuts. Strategic investment approach. Rick Rule advises investors to adopt a strategic approach when investing in silver. He emphasizes the importance of understanding market dynamics, historical trends, and the underlying factors driving demand and supply. Rule's investment philosophy is rooted in patience and a long-term perspective, recognizing that markets work over time and that reversion to the mean is a powerful force. Conclusion. In summary, Rick Rule's perspective on silver is shaped by his extensive experience and deep understanding of natural resource investments. He views silver as a volatile yet valuable investment, driven by its dual role as a precious metal and an industrial commodity. Rule's insights highlight the importance of strategic investment, strong fundamentals, and a long-term outlook in navigating the silver market. Stay tuned as we move towards the apex of our analysis, where we will synthesize all these insights to explain how the factors discussed could lead to silver reaching unprecedented levels, as predicted by Rick Rule. Don't forget to subscribe to our channel for more in-depth analyses and market updates. If you find these insights valuable, make sure to hit the notification bell to stay updated with our latest content on precious metals and other investment opportunities.
Fairly far forward, natural gas isn't hated, but it's becoming hated. People are impatient for its moving. Lithium is certainly hated. I think it's going to become more hated. But I'm learning about lithium because I think a couple years from now, it will be as hated as uranium was in 2022. I think nickel, in particular, sulfide nickel is hated. I think you'll start to see a move up in the nickel price when, as, and if the problems in the Ukraine stop. The reason for that is that one of the reasons for the nickel price weakness is Russian dishoarding. But the truth is, Dunnigan, if you'll remember back about 3 years ago in interviews that we did for your viewers, that would be the Paleolithic. But anyway, if you look pretty far back, what I said was that I like commodities that are necessary for the ongoing well-being of humankind, but priced on a global market at a discount to their production cost. So you look for something where the pricing is really, truly underwater. Knowing that if it continues underwater, the commodity will become unavailable. So if it's a commodity that's needed for, maintaining the lifestyle of the human race, say like uranium for electricity, and it's priced below the cost of production, you know that either the lights go on or the price goes up. Lithium is not yet below the total cost of production, but I think it's headed that way. And I think the lithium-ion battery is important for the electrification of the world. So I'd be looking at lithium in the future. I'd be looking at platinum and palladium in the future. They're really in the toilets now. And I'd be looking at nickel. Natural gas, as a consequence of the fact that it's a byproduct often of oil production and oil prices are strong, probably doesn't yet qualify as hated, because most people look at oil and gas rather.
Let's delve into the broader historical context and future outlook for silver, focusing on its capabilities as a hedge against inflation compared to gold. While both metals are often viewed as safe havens during economic turbulence, their price trajectories, influenced by various factors, can differ significantly. This understanding is crucial to grasp why experts like Rick Rule remain optimistic about silver's potential. Historical performance as a hedge against inflation. Gold has traditionally been seen as a more reliable hedge against inflation compared to silver. Its limited industrial use means that its price movements are primarily driven by investor demand and macroeconomic factors. In periods of high inflation, such as the 1970s, gold's price surged as investors sought to protect their wealth against the declining purchasing power of fiat currencies. Silver, while also viewed as a hedge against inflation, has a more complex relationship with economic factors due to its significant industrial demand. Historical data shows that silver's performance as an inflation hedge can be more erratic than gold's. For instance, during the high inflation of the late 1970s, silver prices skyrocketed, but they also experienced sharper declines during subsequent periods of economic stability. The gold-to-silver ratio is a valuable tool for investors to assess the relative value of these two metals. Historically, this ratio has fluctuated, reflecting periods where silver outperformed gold and vice versa. During times of economic expansion and robust industrial demand, silver often narrows the gap with gold. Conversely, during periods of economic uncertainty, gold typically outperforms silver, causing the ratio to widen. Currently, the ratio remains a key indicator for investors. A high ratio might suggest that silver is undervalued compared to gold, presenting potential buying opportunities. Conversely, a low ratio could indicate that silver is relatively overvalued. Monitoring this ratio helps investors make informed decisions based on historical price relationships. Silver's unique industrial demand significantly impacts its price volatility. Unlike gold, whose primary demand is for investment in jewelry, silver is extensively used in various industrial applications. This dual demand can lead to more pronounced price movements. For example, advances in technology and green energy solutions, such as solar panels and electric vehicles, are driving increased demand for silver. This industrial growth potential adds a bullish dimension to silver's outlook, complementing its role as a safe haven. The current economic environment is characterized by persistent inflation, a cautious Federal Reserve, and a weakening U.S. dollar. These factors create a favorable backdrop for both gold and silver. However, silver's additional industrial demand gives it an edge in periods of economic recovery and technological advancement. Persistent inflation erodes the purchasing power of fiat currencies, prompting investors to seek refuge in precious metals. The Federal Reserve's cautious stance on interest rate cuts further supports this trend, as higher rates typically strengthen the dollar, making precious metals less attractive. However, with the Fed potentially delaying rate cuts, the dollar remains relatively weaker, enhancing the appeal of dollar-denominated assets like silver. Rick Rule's optimism about silver is grounded in these multifaceted market dynamics. He recognizes that while silver can be more volatile than gold, its industrial demand and historical performance, as a hedge against inflation, offer significant upside potential. Rule's investment philosophy emphasizes the importance of understanding these complex relationships and adopting a long-term perspective. For investors, the current market conditions suggest a strategic approach to silver investments. Understanding the interplay between industrial demand, inflationary pressures, and monetary policies is crucial. Investors should also consider the historical gold-to-silver ratio as a guide for timing their investments. Diversifying portfolios to include both gold and silver can provide a balanced hedge against economic uncertainties while capturing growth opportunities from industrial demand.
Casey famously describes it as a floating abstraction. I'm a little more generous than that. The dollar is a medium of exchange. I would argue it's not a store of value. A medium of exchange that has a legal monopoly on settlements transactions in the United States of America. It is backed by the full faith and credit of the government of the United States, and by extension, your full faith and credit and the government's call on the value of your assets and the value of your earnings. In other words, the dollar is backed by you. You need to decide what kind of collateral that is and what circumstance would be occasioned by a call on the value of the dollar. Maybe Doug's definition is pretty good. After my long-winded definition, a floating abstraction actually sounds pretty good.
After exploring the intricate dynamics of the silver market, it's time to synthesize all this information and explain how these factors could lead to silver reaching unprecedented levels, potentially even hitting Rick Rule's ambitious target of $3,000 per ounce. This apex brings together historical data, current market conditions, and future projections to outline a compelling case for a significant silver rally. Inflation is a primary driver for precious metals, and the current economic environment suggests that inflation will remain a persistent issue. With the U.S. Producer Price Index, PPI, showing ongoing price pressures and the Consumer Price Index, CPI, expected to reflect similar trends, investors are increasingly looking for assets that can preserve their wealth. Silver, with its historical role as a hedge against inflation, is an attractive option. The Federal Reserve's cautious approach to interest rate cuts further supports the case for a silver rally. Higher interest rates typically strengthen the U.S. dollar, making dollar-denominated assets like silver less attractive. However, the potential delay in rate cuts keeps the dollar weaker, enhancing silver's appeal. Additionally, if economic conditions necessitate a shift towards rate cuts to stimulate growth, the resulting weaker dollar would further boost silver prices. Silver's unique industrial demand distinguishes it from gold. The metal's extensive use in electronics, solar panels, electric vehicles, and medical devices ties its price to technological and industrial growth. As global efforts towards renewable energy and technological advancements continue, the demand for silver in these sectors is expected to rise. This ongoing industrial demand provides a strong foundation for silver's value, contributing to its potential price surge. Silver's smaller market size compared to gold means that price movements can be more pronounced. This volatility can work in favor of investors during bullish periods. Historical data shows that silver can experience sharp price increases during times of high demand and economic uncertainty. With current market conditions creating a perfect storm of factors favoring silver, this volatility could lead to substantial price gains. The gold-to-silver ratio remains a valuable indicator for assessing silver's relative value. Currently, this ratio suggests that silver is undervalued compared to gold. As investors seek opportunities in undervalued assets, a rebalancing of this ratio could drive significant capital into the silver market, pushing prices higher. Rick Rule's extensive experience in natural resource investments lends credibility to his bullish outlook on silver. His emphasis on the metal's dual demand profile and the current economic conditions aligns with historical trends that have previously driven significant silver rallies. Rule's insights underscore the potential for substantial gains in the silver market. Combining these factors, the potential path to $3,000 per ounce for silver becomes clearer. Persistent inflation and a cautious Federal Reserve set the stage for increased investor demand for precious metals. The unique industrial applications of silver, coupled with technological advancements and renewable energy initiatives, provide a robust foundation for sustained demand growth. The historical volatility of silver and its smaller market size mean that even modest increases in demand can lead to significant price spikes. Moreover, the gold-to-silver ratio indicates that silver is currently undervalued, suggesting room for significant price appreciation as the market adjusts. Rick Rule's confidence in silver, backed by his deep industry knowledge, further supports the case for a major rally. In conclusion, the convergence of persistent inflation, favorable Federal Reserve policies, robust industrial demand, historical market dynamics, and expert insights creates a compelling case for a substantial silver rally. As these factors align, the possibility of silver reaching $3,000 per ounce, as predicted by Rick Rule, becomes increasingly plausible. If you're considering investing in silver, now might be the time to act. The unique combination of economic and market conditions presents a rare opportunity to capitalize on silver's potential. Remember, investing in precious metals carries risks, and it's essential to do thorough research and consider your investment strategy carefully. Don't forget to subscribe to our channel for more in-depth analyses and market updates. Hit the notification bell to stay informed about the latest trends and opportunities in the precious metals market and beyond. And always remember, this is not financial or investment advice. Make sure to consult with a financial advisor to tailor investments to your specific circumstances. Stay tuned for more insights, and thank you for joining us on this journey through the exciting world of silver investments.